Today, we examine the profound macroeconomic and microeconomic implications of yesterday's coordinated United States airstrikes against ISIS targets in northwestern Nigeria, specifically in Sokoto State. Conducted with full Nigerian government approval as part of ongoing counterterrorism cooperation, this development carries significant ramifications for West African economic stability, international investment flows, and regional development trajectories that extend far beyond immediate security considerations. Nigeria's economic context. Nigeria's economy, Africa's fourth largest and most populous nation, with over 237 million people, presents a complex macroeconomic landscape. According to recent National Bureau of Statistics data, the economy expanded 3.98% year-on-year in Q3 2025, driven primarily by the non-oil sector, which contributes 96.6% to GDP. This growth occurs against a backdrop of significant structural challenges, including persistent inflation hovering around 22%, currency pressures, and an economy heavily dependent on oil revenues despite ongoing diversification efforts. The International Monetary Fund projects Nigeria's nominal GDP at approximately $285 billion for 2025, though alternative calculations accounting for the substantial informal economy estimated at 57% of economic activity suggest the true figure approaches $2.59 trillion in purchasing power parity terms. This massive informal sector, while demonstrating entrepreneurial resilience, also represents vulnerability to economic shocks that formal support systems cannot easily buffer. Nigeria's recent GDP rebasing to 2019 parameters elevated national output figures substantially and reduced the debt-to-GDP ratio from 42.9% to approximately 39.8%, providing theoretical fiscal space. However, the World Bank emphasizes that these macroeconomic gains have yet to translate into tangible improvements in citizens' daily lives, with poverty and food insecurity remaining critically high despite technical economic growth indicators. Macroeconomic Impact Framework. The immediate macroeconomic implications of military operations in northwestern Nigeria manifest through three primary transmission mechanisms, each carrying distinct but interconnected economic consequences. First, foreign direct investment sentiment deteriorates when military operations occur within national borders, regardless of coordination level with host governments. Historical analysis of comparable situations across emerging markets demonstrates that FDI inflows to conflict-adjacent regions declined 15 to 23% during active military operations, with recovery periods extending 12 to 18 months beyond cessation of visible military activity. Nigeria recorded capital importation of $5.64 billion in Q1 2025, representing 67% growth year over year. However, approximately 92% of these inflows consisted of portfolio investments, with genuine FDI reaching only $126 million. This portfolio-heavy structure indicates hot money that can exit rapidly during periods of heightened risk perception, making the investment base particularly vulnerable to security developments. International oil companies have already demonstrated heightened sensitivity to Nigerian security conditions. Shell and Total Energies have announced exits from onshore operations, with executives explicitly citing security concerns alongside environmental policy considerations. The Petroleum Industry Act reforms aimed at attracting investment face renewed headwinds when military operations reinforce perceptions of persistent instability. Second, currency markets face renewed depreciation pressure despite recent Naira stabilization efforts. The exchange rate currently trades around 1,450 Naira per dollar, representing improvement from early 2025, peaks near 1,680 Naira per dollar. However, Central Bank of Nigeria foreign reserves exceeding $42 billion, while improved, provide limited buffer against sustained capital flight scenarios given Nigeria's substantial import requirements and external debt service obligations. The currency stabilization achieved through 2025 relied heavily on central bank liquidity support measures and improved oil production, reaching 1.64 million barrels daily in Q3 2025. Security concerns that suggest persistent risk premiums can quickly reverse these gains, particularly given Nigeria's current account surplus dependence on oil export revenues. Any perception that security instability might affect oil production, even in geographically distant regions, creates currency pressure through psychological transmission mechanisms affecting trader sentiment. Third, oil production disruption risks emerged despite Sokoto State operations occurring distant from primary extraction zones concentrated in the Niger Delta. Nigeria loses an estimated 200,000 to 400,000 barrels daily to theft and pipeline vandalism, costing approximately $2 billion annually. Security instability in any region creates insurance premium increases and operational cost escalation for international operators maintaining nationwide presence. The government's stated ambition to boost production by 1 million barrels daily within 2 years to reach 2.06 million barrels daily requires sustained security improvements across all operating regions. PricewaterhouseCoopers analysis emphasizes that achieving 2025 production targets necessitates 37% output increases from current levels, dependent on completing key projects including Shell and Total Energy's Bonga deepwater field developments announced late 2024. Sokoto State microeconomic disruption, Sokoto State's economy, where airstrikes occurred, merits particular analytical focus given its unique economic structure and development trajectory. Agriculture contributes approximately 42% of Sokoto's GDP, with over 70% of the population engaged in farming activities. The state ranks second nationally in livestock production, with animal populations exceeding 8 million, while contributing nearly 40% of Nigeria's onion production at roughly 800,000 metric tons annually. Governor Ahmed Aliyu's agricultural transformation agenda, centered on irrigation revival and export-oriented farming, was generating momentum prior to yesterday's events. Sokoto produces cash crops including wheat, cotton, and vegetables, alongside subsistence agriculture in millet, sorghum, maize, and rice. The state maintains significant cross-border trade with Niger Republic, with existing commercial networks moving cement, agricultural products, and livestock across regional boundaries. Military operations disrupt these commercial networks immediately through 3 channels. Local farmers face market access constraints as security measures restrict movement along traditional trading routes. Transportation costs increase as logistics companies factor risk premiums into pricing structures, while insurance coverage becomes more expensive or unavailable entirely for certain business categories operating in affected regions. Small and medium enterprises throughout northwestern Nigeria encounter increased operating costs requiring security expenditure increases, transportation cost escalation, and insurance premium hikes. The displacement effect creates temporary unemployment spikes in affected areas, while security sector employment expands as both government and private entities increase protective staffing levels. This employment reallocation typically reduces overall productivity, as security work produces less direct economic value than displaced commercial activities. Sokoto's strategic position, sharing borders with Niger Republic and proximity to trade corridors reaching Burkina Faso and other Sahelian economies, creates regional spillover effects. Cross-border commerce experiences immediate friction precisely when regional integration efforts under ECOWAS and the African Continental Free Trade Area seek to enhance intra-regional trade flows. Nigeria currently exports only 10% of total trade within the continent, suggesting substantial unrealized potential that security disruptions further constrain. Financial market transmission mechanisms. Nigerian sovereign bonds traded at elevated spreads relative to comparable emerging market debt throughout 2025, reflecting investor concerns about fiscal sustainability and political risk. This military development likely widens those spreads further as international investors demand additional compensation for perceived political risk intensification. Government borrowing costs increase accordingly, constraining fiscal policy flexibility precisely when economic stimulus measures might prove beneficial for maintaining growth momentum. In December 2024, Nigeria successfully tapped international markets for the first time since 2022, issuing 2 Eurobonds totaling $2.2 billion that were highly oversubscribed, demonstrating investor appetite under stable conditions. However, this appetite proves contingent on risk perceptions that can shift rapidly following security events, regardless of their successful execution or government approval. The Nigerian Stock Exchange experiences sector-specific impacts rather than broad-based declines following security developments. Companies with northern operations face immediate valuation pressure as analysts incorporate higher operating cost assumptions and reduced growth projections into financial models. Banking sector stocks remain vulnerable given loan exposure to affected regions and broader economic uncertainty affecting credit quality assessments. Defense contractors and security service providers may experience positive revaluation as the market anticipates increased government and private sector spending on protective measures. However, this sector rotation toward security-related equities represents economically unproductive capital allocation, diverting resources from growth-generating investments in manufacturing, technology, and infrastructure development. The domestic banking sector, while remaining stable with improved capital adequacy ratios, faces deteriorating non-performing loan metrics, especially among microfinance banks and development finance institutions. Regional economic disruption compounds these asset quality pressures, potentially requiring increased provisioning that reduces lending capacity precisely when SMEs require credit access to navigate challenging operating environments. Regional integration and trade disruption. West African economic integration faces significant setbacks when member states experience security challenges affecting their largest economy. The Economic Community of West African States facilitates substantial intra-regional trade that security operations immediately disrupt. Cross-border commerce with Niger, Chad, and Cameroon experiences friction through enhanced border controls, transportation delays, and elevated insurance costs that reduce trade profitability. Nigeria's trading infrastructure currently serves commodity exports directed primarily toward European and Asian markets while importing refined oil products, machinery, and consumer goods from these same economies. Increased investment in port and road infrastructure could potentially double intra-African trade from current $8.5 billion annually, but security instability delays these infrastructure investments while reducing private sector confidence in regional expansion strategies. Recent geopolitical shifts in Niger and Burkina Faso, including coups and regime changes, have already disrupted traditional trade flows that Sokoto State historically maintained with Sahelian neighbors. Military operations in northwestern Nigeria compound these disruptions precisely when economic cooperation mechanisms could provide stability anchors during regional political transitions. Oil sector vulnerability and production constraints. Nigeria's oil industry continues facing multifaceted challenges extending beyond immediate security concerns. Production remains significantly below capacity, with output reaching 1.64 million barrels daily in Q3 2025, compared to historical peaks exceeding 2.5 million barrels daily in 2010. This represents production declines averaging 5% annually from 2012 through 2022, equivalent to losing output matching Angola's total production. The Nigerian Association of Petroleum Explorationists warns that without urgent new exploration and discoveries, production could decline further in coming years. Renewed investment in exploration proves critical for ensuring long-term energy security, yet security concerns directly undermine these investment requirements. Exploration activities require stable operating environments with predictable security costs that allow project economics to justify capital commitments extending over decade-long timeframes. Pipeline infrastructure faces persistent sabotage challenges. The Trans-Niger pipeline explosion earlier in 2025 highlighted ongoing vulnerabilities affecting exports, representing 15% of national output. In 2022, this pipeline was reportedly perforated by illegal connections across less than 200 kilometers, demonstrating the scale of infrastructure security challenges facing operators. International operators increasingly favor offshore developments over onshore operations precisely because offshore facilities avoid terrestrial security risks. However, this operational pivot reduces employment in onshore regions while limiting technology transfer and local content development that onshore operations typically generate. The long-term economic development implications prove substantial as communities lose employment opportunities and governments forego tax revenues from foregone onshore production. Agricultural sector and food security implications. Nigeria's agricultural sector, accounting for approximately 24% of national GDP and employing nearly 50% of the working population, faces particular vulnerability to security disruptions in producing regions. Sokoto's agricultural transformation initiatives, including irrigation revival supported by the Goronyo Dam and various lake systems, require sustained security conditions enabling farmers to access fields, transport produce to markets, and receive technical support from agricultural extension services. Food inflation remains Nigeria's most pressing consumer challenge, with food price increases functioning as what World Bank economists term the biggest tax on the poor. Tackling food inflation requires removing trade barriers, including import bans and excessive duties, while addressing structural bottlenecks in seeds, input supply, security, logistics, and infrastructure, including transport, power, storage, and cold chain facilities. Security disruptions in major producing regions like Sokoto directly contradict food security objectives by reducing agricultural output precisely when Nigeria requires increased production to meet growing population needs exceeding 237 million people. The state's contribution of 40% of national onion production means that even modest disruptions to planting or harvesting cycles create measurable impacts on nationwide vegetable availability and pricing. Sokoto's livestock sector, ranking second nationally, faces similar disruption risks. Cattle, goats, and sheep production requires extensive grazing areas and movement along traditional pastoral routes that security operations inevitably constrain. The economic implications extend beyond immediate livestock producers to encompass downstream leather processing industries, meat processing facilities, and dairy operations dependent on consistent animal supply streams. Long-term structural economic concerns, Nigeria's economic diversification efforts, central to reducing oil dependency that currently represents 90% of export revenues, require sustained foreign investment and stable operating environments that security operations inevitably complicate. Non-oil sector growth, while robust at 3.91% in Q3 2025, depends on investor confidence in long-term stability, enabling multi-year investment planning horizons. The services sector, contributing over 55% of GDP following the 2025 rebasing, includes telecommunications, financial services, real estate, and trade activities that all require stable business environments. Information and communication services posted robust 5.78% expansion in Q3 2025, but technology companies contemplating network infrastructure investments or data center developments factor security assessments into location decisions affecting capital deployment patterns. Manufacturing sector growth remains modest at 1.25%, despite representing crucial diversification priorities. Industrial development requires electricity reliability, transportation infrastructure, and supply chain predictability that security uncertainties undermine. Nigeria's manufacturing sector suffers from inadequate infrastructure and security challenges in mineral-rich regions, with access to electricity, transportation to production sites, and outdated equipment representing critical operational barriers. Monetary policy dilemmas. The Central Bank of Nigeria faces increasingly complex monetary policy decisions as security developments compound existing inflation management challenges. The policy rate remains at 27%, reflecting aggressive tightening aimed at controlling inflation that peaked above 34% before recent moderation. However, inflation pressures from supply chain disruptions argue for maintaining tight policy, while economic growth concerns suggest accommodation might prove beneficial. The Naira's weakness limits policy flexibility further, as aggressive rate increases could trigger debt service difficulties for leveraged businesses operating with foreign currency exposures. The central bank maintains limited foreign exchange reserves relative to import coverage requirements, making the currency vulnerable to sentiment shifts, driving capital outflows that security developments can catalyze. Monetary policy transmission mechanisms show reduced reliability during current economic conditions, as Federal Reserve Chairman Powell acknowledged, regarding similar challenges facing U.S. policymakers. Standard models for predicting policy impacts demonstrate diminished effectiveness, complicating calibration decisions when inflation control competes with growth support objectives. Fiscal constraints and budget implications. Fiscal policy responses remain severely constrained by existing debt burdens and revenue collection challenges. Nigeria's government debt-to-GDP ratio, while technically manageable at 39.8% following rebasing, occurs alongside relatively low tax revenue collection, around 12% of GDP, that limits budgetary flexibility for stimulus measures that economic disruptions might warrant. The 2025 budget, valued at lowest level since 2018 in dollar terms, allocates less than 20% for capital expenditure, despite Nigeria requiring substantial infrastructure investment for development and poverty reduction. Untargeted oil subsidies scheduled for phase-out by 2028 should provide fiscal relief, though implementation proves politically challenging given the immediate household impacts from subsidy removal. Over 4,500 violent incidents and 5,356 criminal activities occurred between January 2023 and March 2024, including farmer-herder clashes and oil theft, according to PricewaterhouseCoopers analysis. These security challenges cause significant revenue losses while requiring increased government expenditure on security operations that divert resources from productive investments in education, healthcare, and infrastructure development. Investment climate assessment. Nigeria's investment climate deterioration poses perhaps the most significant long-term economic consequence of persistent security challenges. International operators have increasingly viewed Nigeria as a high-risk investment environment due to security threats, corruption, and policy inconsistencies. Foreign direct investment in the oil sector has followed a downward trajectory, with major international companies reducing exposure or exiting operations entirely. The potential economic impact of investment decline extends across multiple sectors. Reduced private capital availability limits small business expansion and technological innovation, typically driving productivity improvements and employment creation during economic expansion phases. Venture capital and private equity sectors have adjusted strategies in response to higher interest rates and increased economic uncertainty, with exit activity declining substantially from previous years. The informal economy, representing perhaps 60% of Nigerian economic activity, proves especially vulnerable to security disruptions. Informal sector participants lack access to insurance mechanisms or government support programs that might buffer economic shocks affecting formal businesses. Their resilience depends entirely on market access and customer purchasing power, both immediately compromised when security developments restrict movement and reduce consumer confidence. Conclusion and forward indicators. This coordinated military operation, while addressing legitimate security concerns against ISIS operations in northwestern Nigeria, introduces economic headwinds for an economy already navigating substantial structural challenges. The combination of foreign direct investment uncertainty, currency pressure, agricultural disruption, and regional commercial friction creates conditions that historical analysis suggests typically reduce GDP growth trajectories. International investors monitoring Nigerian exposure should track three key indicators providing early signals of economic stress deepening or stabilizing. First, Naira exchange rate stability against major currencies, particularly movements in both official and parallel market rates. Second, central bank foreign reserve adequacy, measured against import coverage requirements and external debt service obligations. Third, government bond spreads relative to comparable emerging market sovereigns, indicating risk premium evolution. The broader implication extends to questions of West African regional stability and the complex interplay between security requirements and economic development in emerging markets facing asymmetric threats. Nigeria's experience provides case study material for understanding how counterterrorism operations, regardless of military effectiveness or government approval, inevitably generate economic consequences requiring careful management to minimize long-term development impacts. The coming 90 days will prove particularly revealing as agricultural cycles progress, investment decisions crystallize, and market participants assess whether yesterday's operations represent isolated tactical action or signals of extended military engagement requiring fundamental reassessment of Nigerian operating environment risk parameters. The government's communication strategy, security force effectiveness in preventing ISIS reconstitution, and economic policy responses will collectively determine whether economic impacts remain transitory or evolve into sustained headwinds, constraining Nigeria's development trajectory through 2026 and beyond. Today, we examine the profound macroeconomic and microeconomic implications